Is Indian banking system safe? Is our money safe in banks in India? Hello everybody, I have already made one video on how the banks in America is collapsing one after another, and 190 American banks are about to join them in this upcoming collapsing race. It is undeniable that the entire American economy is already under recession, and high debt, mass banking collapse and uncontrollable inflation is inviting an inevitable market crash and global currency reset, leading towards establishment of new world order. But what about our country India? Will our country India going to face the same challenge as America? Is our banking system safe from the bank run storm? Is our money safe in Indian banks? Let's find out all these answers in this video. American banks are going through bank defaulting situation nowadays because of these reasons. Number one, heavy exposure in US long-term treasury bonds. And number two, lending too much money at lower interest rates in 30 years fixed rate mortgages. Let's discuss these points one by one. Number one, heavy exposure in US long-term treasury bonds. Though the quantitative easing in US is happening since the global financial crisis of 2008, but mainly during the COVID-19 lockdown, due to the rate cuts, quantitative easing and government stimulus packages, cash was overflowing in both US and Indian economy. Do you want to know how much cash was released in the economy? Let's find out. In USA, till September 2019, the total US Fed balance sheet was approximately 3.8 trillion US dollar, that went up to 8.9 trillion US dollar in the May 2022. That means during that period, the US federal balance sheet has surged more than 234%. Though now in April 2023 it has come down to 8.6 trillion US dollar, but still it is remained at 226%. That is the main reason of high inflation in USA. On the other hand, in India, the RBI's balance sheet was roughly 20 trillion Indian rupees or 0.24 trillion US dollar at the beginning of the year 2020 and went up to 35 trillion Indian rupees or 0.43 trillion US dollar. That means during that period, the Reserve Bank of India's balance sheet had surged roughly near about just 75% to 80%. That is much lesser than the US Fed's balance sheet explosion. And anyhow, because of this government intervention, both the economy survived after COVID-19. But the problem arose when all the US banks started to invest excess cash in government treasury bonds. During the COVID-19 lockdown period, both the economies were shut down and businesses were closed. But in USA, government provided COVID relief payments from 1,200 to 1,400 US dollar to every individuals per month, along with the US unemployment benefits of 300 US dollar to 400 US dollar per week. Not only that, except this, US Fed started to buy back their assets and bonds to provide the adequate liquidity in the businesses and in the US economy. This huge money started to get deposited into the US banks, especially in the regional banks. But as the businesses were closed and economy was uncertain, at that time banks decided to put this huge excess money to US treasury bonds to meet the interest payment burden of the depositors of the US banks. And they made the huge mistake by investing this money in long-term treasury bonds than short-term treasury bonds, as long-term bonds generally provide relatively higher interest rates than short-term duration bonds. Bank wrongly predicted that the US economic recovery will take more time than its anticipation, and rates in the US economy will not be increasing so fast. But this anticipation gone wrong, and to curb the inflation, US Fed increased its rate of interest from 0.25% to 5% within a year. And as a result, the value of their purchased bonds started declining, as the bond price is interest sensitive, and with the growing interest rates, the value of the bond declines. Because why should anyone buy low interest bearing old bonds than high interest bearing newly issued bonds? And because of that reason, as I have already mentioned in my previous video, that the banks in America sitting at total unrealized losses worth of almost 1.7 to 2 trillion US dollar, among which Bank of America has biggest losses in its bond portfolio. In its 862 billion US dollars of bond portfolio, 632 billion US dollar worth of bond portfolio is Federal Reserve bonds that, due to account loopholes, this type of government bonds are considered to be held till maturity or HTM instruments. Means its losses are not recorded and reflected in the bank's balance sheet, as this type of government bonds are considered to be the safest ever bonds, and at the maturity government is going to pay the entire invested capital in return to the banks. But in reality, total loss of the Bank of America is 109 billion US dollar at the end of 2022. Similarly, other bigger banks like JP Morgan Chase bond portfolio loss is 36 billion US dollar, Wells Fargo's loss is 41 billion US dollar, Citigroup's loss is 25 billion US dollar, and Goldman Sachs loss is 1 billion US dollar. And if 50% of the uninsured depositors decide to withdraw their money from their banks, then all the banks will become insolvent. But in case of India, this situation is a bit different. In this case, one of our disadvantage has become our advantage. If you compare the global bond market, then you will find that in global bond market, the US and China holds approximately 55% market share, where America's bond market size is 51.3 trillion US dollar and India's bond market size is just around 1.3 trillion to 1.8 trillion US dollar, among which roughly 1.2 trillion US dollar comes under government securities and 0.6 trillion US dollar comes under corporate bonds. So clearly you can see that our bond market is not so strong or widely spread. For that reason, the investment done on the bonds by our Indian banks are much lesser than the banks of United States and China. According to the recent reports on Indian banks by brokerage firm Jefferies, it is found that only 22% to 28% of the total assets of most of the Indian banks are invested in the bonds and other government securities, and out of which 80% of their total investments in securities falls under the government securities that comes under held to maturity or HTM category. Means only the purchasing cost of these bonds are recorded in the bank's balance sheet, not the actual present value of the bonds. Though this accounting principle need to be changed, as because of which banks can successfully hide their bond denominated asset losses, but still the investment by the Indian banks in fixed income assets like government bonds and corporate bonds are much lesser than the US banks. Additionally, RBI has capped this bond holding limit by banks at 23%. That means all the banks in India are allowed to put just 23% of their total assets in fixed income assets like corporate bonds and government securities. And according to this, RBI is planning this percentage to come down to 19.5% in a phased manner from June 2024. If you compare this ratio with Silicon Valley Bank, they held 43% of their assets in the form of held till maturity securities or bond denominated assets, and most of their depositors were corporates and startup companies. That is considered one of the most unstable source of deposit in the banks. Whereas in case of Indian banks, not only our investment cap in bonds denominated assets are less, just 23%, and in India the deposit guarantee cap is up to 5 lakh rupees that provides protection to 98% of the bank depositors. Not only that, as far as the unrealized losses are concerned, unlike US banks 2 trillion US dollar piling up losses, Indian private banks capital is going to get impacted by just 6%, and public sector banks capital is going to get impacted by just 15%. That suggests that no any banks in India is going to face the bank run situation like USA, and Indian banking system is 100% safe. Now let's discuss the second point, that is lending too much money at lower interest rates in 30 years fixed rate mortgages. And as you can see in this chart, that with declining interest rates, the mortgage applications started rising massively in USA. Though the same situation can be observed in case of India also, but the basic difference is in US mortgage owners can avail mortgage loans at fixed rate of interest for up to 30 long years. That means for the entire loan period, the EMI of the loan will remain the same. That means with the growing interest rates, the borrower need not to pay any extra amount. That sounds great, as with the increasing inflation rate, the property value will increase, but the borrower don't have to pay a single extra penny to the US banks. Though it is good for the borrowers, but it is bad for the banks, as they will be losing money with every percentage of interest rate hike by Fed in one side. On the other side, due to interest rate hike and cash crunch situation, banks gradually will be out of cash. Borrowers will be enjoying the benefit of negative interest rates and lender will be suffering for the same. It is estimated that more than 40% of the fixed interest rate mortgage loan was availed by the home buyers and mortgage owners during the period of 2020-21. And for that reason, US banks are incurring huge opportunity cost losses along with cash crunch obligations. Now in USA, the rate of interest is 5% and the bank deposit interest rate, say suppose 4% to 5%. And if anyone put their money in banks, then bank have to pay interest to its depositors. But still, if bank cannot make profits on its loan, then how the bank can repay the interest to its depositors? And this type of situation is continuously mounting on the banking system of the US. And if continuously banks in USA incur losses, then they will not be able to provide interest to the depositors, and they have to cut the interest rate. And if they cut the rate of interest, then investors will switch their fund from banks to other institutions. And if they cut interest rates, then people will withdraw their funds and invest in government bonds, corporate bonds and other alternative investments, because at that time the bank rate of interest will not remain so attractive, and then banks will be again out of cash and face the bank run situation. In long run, it may push them towards the insolvency. Thankfully, in case of India, this thing will not happen, as fixed rate of interest mortgage loan are not available in India. Though some banks are offering fixed rate of interest to its borrowers, but still the tenure of the fixed rate is kept between 2 to 3 years only. As a result, with growing interest rate, the loan interest rate also increases and banks' cash flow also increases alongside. And banks never face any cash crunch condition in India for that reason. For this reason, our Indian banking system is much safer and secure until any yes bank type of situation comes into existence. So that's it for today. If you find this video useful, then kindly share this video with your friends, colleagues and family members. And to get more updates and support this channel, kindly subscribe this channel and press the bell icon for more future updates, and kindly press the like button along with your suggestion in the comment box. Till then, bye bye.